Hello everyone, I'm Joey and welcome back. Over the past few weeks, one question has been dominating conversations on Wall Street in Washington and around kitchen tables across America. Will the Federal Reserve raise interest rates again? It may sound like a question that only economists or investors care about. But the truth is, the Fed's next decision could affect almost every American. Whether you're planning to buy a home, finance a new car, use a credit card, start a business, or simply save money, interest rates have a direct impact on your financial future. And right now, uncertainty is growing. Inflation has shown signs of becoming more persistent than many expected. Energy prices remain unpredictable. Import tariffs are increasing costs for some businesses. And while the U.S. economy continues to grow, the Federal Reserve is facing one of the toughest balancing acts in modern economic history. Raise rates too much, and the economy could slow dramatically. Cut rates too soon, and inflation could surge once again. So, what exactly is happening? Why does the Federal Reserve have so much influence over the economy? And what should everyday Americans expect over the next several months? Today, we're going to explain everything in simple language. No complicated charts, no confusing financial terms. Just a clear explanation of what's happening and why it matters to you. Let's begin. What is the Federal Reserve? Before we talk about interest rates, we first need to understand what the Federal Reserve actually does. The Federal Reserve, often called simply the Fed, is the central bank of the United States. Think of it as the country's financial referee. Its job isn't to make political decisions. Its responsibility is to help keep the economy as stable as possible. Congress has given the Fed two primary goals. The first, maintain stable prices. The second, support maximum employment. Those two objectives sound simple, but in practice, they're incredibly difficult to balance, because sometimes helping one goal makes the other more challenging. Why inflation is the Fed's biggest concern? Inflation simply means that prices increase over time. A small amount of inflation is considered normal. In fact, the Federal Reserve generally aims for inflation around 2% over the longer term. Why? Because moderate inflation usually reflects a healthy, growing economy. But when inflation rises too quickly, problems begin. Families pay more for groceries. Gasoline becomes more expensive. Rent increases. Insurance premiums rise. Businesses face higher operating costs. And every dollar buys a little less than it did before. That's what economists call a loss of purchasing power. Imagine earning exactly the same salary for 3 years. If prices rise significantly during that time, your paycheck hasn't changed, but your standard of living has. Without receiving a raise, you can afford fewer goods and services than before. That's why controlling inflation is one of the Fed's highest priorities. How does the Fed fight inflation? This is where interest rates enter the picture. When inflation becomes too high, the Federal Reserve can increase its benchmark interest rate. That single decision influences borrowing costs across the entire economy. Banks begin charging higher interest on loans. Mortgage rates often rise. Car loans become more expensive. Credit card interest increases. Businesses also face higher borrowing costs. The goal is simple. When borrowing becomes more expensive, consumers usually spend a little less. Businesses invest more carefully. Demand begins slowing. As demand cools, price increases may eventually slow as well. In other words, higher interest rates are designed to reduce inflation, even though they may temporarily slow economic growth. Why doesn't the Fed just keep raising rates? At first, that may sound like the obvious solution. If inflation is high, why not simply continue raising interest rates until prices stop increasing? Because every action has consequences. Higher interest rates don't only affect inflation, they also influence hiring, business investment, consumer confidence, the housing market, stock prices, and overall economic growth. Imagine driving a car down a steep hill. If you slam on the brakes too hard, the ride becomes dangerous. But if you don't brake enough, you may lose control. The Federal Reserve faces a similar challenge. It must slow inflation without causing unnecessary damage to the broader economy. That's why every interest rate decision receives enormous attention from investors around the world. Why are markets so uncertain? Right now, several important factors are making the Fed's job more difficult. First, inflation hasn't disappeared completely. Although price increases slowed from their earlier peaks, recent data suggest inflationary pressures remain in parts of the economy. Second, energy prices remain volatile. Global conflicts can quickly influence oil markets, affecting transportation, manufacturing, and consumer prices. Third, businesses continue adapting to new trade policies, including higher tariffs on certain imported goods. When companies pay more for materials or products, those costs are often passed on to consumers. And finally, the massive investment taking place in artificial intelligence is increasing demand for data centers, electricity, advanced computer chips, and specialized workers. While these investments could improve productivity over the long term, in the short term, they may also contribute to higher costs in certain industries. All of these factors create uncertainty, and uncertainty makes forecasting much more difficult. Why should everyday Americans care? Some people assume interest rate decisions only matter if they're buying stocks. Nothing could be further from the truth. If you're thinking about buying your first home, interest rates matter. If you're planning to finance a vehicle, interest rates matter. If you're carrying credit card debt, interest rates matter. If you own a small business, interest rates matter. Even retirees can be affected because higher rates influence savings accounts, certificates of deposit, bond yields, and investment returns. In other words, the Federal Reserve doesn't just influence Wall Street, its decisions affect Main Street as well. Whether you realize it or not, every household feels the impact in one way or another. So, will the Federal Reserve actually raise interest rates again? What indicators are policymakers watching before making their next move? Could mortgage rates remain high well into next year? And what should families do right now to prepare for whatever comes next? So, will the Federal Reserve actually raise interest rates again? What indicators are policymakers watching before making their next move? Could mortgage rates remain high well into next year? And what should families do right now to prepare for whatever comes next? Let's continue. What will the Fed be looking at? The Federal Reserve doesn't make decisions based on a single report. Instead, policymakers examine hundreds of economic indicators before each meeting. But there are four that receive the most attention. The first is inflation. If prices continue rising faster than the Fed's long-term target, officials may decide that interest rates need to remain higher for longer. The second is the job market. A strong labor market usually means consumers continue spending money, which can keep demand, and sometimes inflation, higher. The third is consumer spending. The American economy depends heavily on household spending. If consumers suddenly reduce purchases, economic growth can slow. Finally, the Fed closely watches financial markets and global events. Oil prices, international conflicts, trade policies, and supply chain disruptions can all influence future inflation. No single number determines the decision. It's the overall picture that matters. What happens if rates go higher? If the Federal Reserve raises rates again, borrowing money could become even more expensive. Mortgage rates may stay elevated. Monthly car payments could increase. Businesses may delay expansion because financing costs are higher. Families carrying credit card balances could pay more in interest every month. For first-time homebuyers, higher borrowing costs can significantly reduce purchasing power. A home that seemed affordable a year ago may suddenly fall outside the budget, not because the price increased, but because the monthly payment did. That's why interest rates have such a powerful impact on the housing market. Could rates finally come down? Many Americans are hoping borrowing costs will begin falling soon, and eventually, they probably will. But the timing depends on one critical factor: inflation. The Federal Reserve has repeatedly emphasized that it wants convincing evidence inflation is moving sustainably toward its long-term target before making significant policy changes. If inflation cools steadily, rate cuts become more likely. But if inflation remains stubborn, officials may choose to wait longer than many investors expect. That's why markets often react so strongly to every inflation report. One unexpected number can completely change expectations about future interest rate decisions. What does this mean for your money? Whether rates rise, stay the same, or eventually fall. There are practical steps every household can consider. If you have high-interest credit card debt, paying it down may become even more valuable while borrowing costs remain elevated. If you're planning a major purchase, make sure you understand how interest rates affect your monthly payments, not just the purchase price. Building an emergency fund is also important during periods of economic uncertainty. Even a few months of essential expenses saved can provide financial stability if unexpected challenges arise. And if you're investing for retirement, remember that markets naturally experience periods of volatility. History shows that making emotional decisions during uncertain times often leads to poor long-term results. Successful investing usually rewards patience, discipline, and consistency rather than reacting to every headline. Why the Fed's decisions affect the entire world. The US dollar is the world's primary reserve currency. Because of that, the Federal Reserve's decisions don't just influence America. They affect global financial markets. Higher U.S. interest rates can attract international investment into dollar-denominated assets. That can strengthen the dollar while creating challenges for some emerging economies that borrow in U.S. dollars. Global investors, multinational companies, and central banks around the world closely monitor every statement from the Federal Reserve because its decisions often influence exchange rates, international borrowing costs, and investment flows. Few institutions have as much influence over the global economy. What should Americans watch over the next few months? As we move forward, several developments will be especially important. Future inflation reports, employment data, consumer spending trends, energy prices, and any significant geopolitical events that could disrupt global markets. Each new report provides another piece of the puzzle. That's why financial markets sometimes move dramatically after major economic data releases. Investors aren't reacting only to today's numbers. They're trying to anticipate what the Federal Reserve might do next. Final thoughts. The truth is, no one, not even the world's top economists, can predict the future with complete certainty. The Federal Reserve will continue making decisions based on incoming economic data, not predetermined outcomes. That's why it's important to stay informed without overreacting to every headline. Economic cycles are normal. Interest rates rise. Interest rates fall. Inflation accelerates. Inflation slows. The key isn't trying to predict every move perfectly. The key is understanding how these changes affect your financial life so you can make informed decisions instead of emotional ones. Knowledge is one of the most valuable financial assets you can have. The better you understand the economy, the better prepared you'll be for whatever comes next. If you enjoyed this breakdown, subscribe for more clear, unbiased explanations of the biggest economic stories affecting your money. I'm Joey, thanks for watching, and I'll see you in the next video.